there are many different models to look at the international cost of capital. And part of this course is designed to try to understand the strengths and weaknesses of these models. Let me go through, in a very quick way, some of these models and some of the problems with these models. The first model is the simplest model. Use the same cost of capital internationally that you use domestically. It's like one cost of capital, one hurdle rate, no matter where you invest. Very simple model, but it kind of flies in the face of most of the stuff that we learn in finance, because it's most likely that investing in Afghanistan is more risky than investing in Oregon. So the one hurdle rate approach is not recommended. Indeed, it's not recommended even for a corporation just investing in the US. The project risk needs to be reflected in the hurdle rate. Second model is kind of a world CAPM model. We all know how to use this, kind of regress the return on the world market. We've got a beta, multiply the beta times the world risk premium, add the risk-free rate, and we've got the hurdle rate. And this model works fairly well for developed countries, but we're concerned with emerging markets mainly in this course. And the model delivers expected rates of return that are very low. Indeed, some countries have negative betas. And negative beta implies that the hurdle rate that you should be using is less than the US Treasury bill rate. And that's kind of hard to buy. Indeed, the hurdle rate could be zero. You know, it makes project evaluation quite easy. Just add the cash flows up. Well, I guess a number of people are a little uncomfortable with that type of model. So there's a number of alternatives. And maybe the most common alternative is a model that's widespread in its use on the street. I kind of call this the Goldman model, but other companies like Solomon Smith Barney also use a model like this. You know, basically, and I'm abstracting a little bit from the model, but to basically calculate the part that you would get from the world CAPM, so the beta times the world risk premium, and then they kind of recognize that that's a little too low, and they'll add to that the sovereign yield spread. So the spread between a government bond from the local country in US dollars to the comparable US Treasury. That spread is positive, and what you do is increase the hurdle rate as a result. So it seems to work in the right direction, and that spread seems to be something that surely does reflect country risk. But it's a little ad hoc to put that in there. And the other thing is that we're talking about an equity cost of capital, and you're inserting some spread based upon bonds. Now we know that bonds are not the same as equity. You think of it for a corporation within the US, the bond expected returns are less than the equity expected returns for good reason. Bondholders get paid first. Equity is residual. Everything is left over after the bond holders are paid off. So to use a spread simply based upon the debt, and to make things even worse, is based upon a government type of debt, doesn't seem to me to be the appropriate adjustment to make in the CAPM. Well, a number of people recognize that even after you add this spread, the hurdle rate still seems too low. Like indeed, if you start at 0 and add 300 basis points, you're only up to 3%. So there's another model out there. And I guess the only two options that you have to increase the hurdle rate are the following. One, you can somehow magnify the country sovereign spread, and the other is to modify the beta. And the approach that Goldman Sachs takes is to modify the beta. And what they do is to, instead of putting the traditional beta in there, which is the covariance between the country and the world divided by the variance of the world, they change that to put in the ratio of the standard deviation of the equity return in that country divided by the standard deviation of the equity return in the world. Now, you know that emerging markets are volatile markets. So almost immediately you know that this beta is greater than 1 and could be as great as 4 or 5. This definitely has the right effect. It increases the hurdle rate dramatically for a number of these markets. But is it the right thing to do? Indeed, I'm not sure how to interpret this volatility ratio. So I'm not convinced by this particular model. Another alternative was somewhat popular, to use what is implied by the CAPM and then just look at historical returns and kind of blend them together in some way to establish what the hurdle rate is. Again, it doesn't make that much sense to me. There are a number of models that do make some sense to me, and I can't go through the details of all of these models right now, but let me sketch them very quickly. The first model is a blending of a local CAPM and a world CAPM. And the idea is that some of these markets started out segmented and have gradually moved towards being integrated. In a model that I proposed with Beckert in 1995, we actually blend together the world CAPM expected rate of return and the local CAPM expected rate of return in a way that allows the weights in the blending to shift through time. As the market becomes more integrated, then more weight is placed upon the world CAPM. This is a very attractive type of model. It's consistent with theory. The problem with the model is these blending weights are very difficult to estimate. This is a model that needs additional research and I think might be prominent in a number of years. Right now, it's practically difficult to implement. Another model that I've published in the June 2000 Journal of Finance adds an extra term to the world CAPM, having to do with skewness. In these markets, skewness is very important. And the interpretation is not the actual skewness of the market, but how incorporating this market into my diversified world portfolio influences the skewness of my diversified portfolio. Something that adds negative skewness I don't like, and I will require a higher rate of return. Something that induces positive skewness I like, and I'm willing to have a lower expected return. The final model, which I'll talk about in more detail later, has to do with the credit rating model. This is an incredibly simple model based upon something I published in 1995. It basically says that a surrogate measure of risk that is dynamic in that it changes through time, that is ex ante in that it looks forward to the future, is a risk rating. Either S&P, Moody's, ICRG, institutional investor, Euromoney, doesn't really matter what you use. The idea is that it represents an ex ante measure or an expected measure of risk. And if it's a decent measure of risk, there should be a relation between the expected returns and this measure.